Hey everyone, and welcome back to the Safe, Simple, Sound podcast, Tax Edition. I'm your host, Alex, and I'm glad you're tuning in. Today, we're tackling a topic that's crucial as we navigate the current tax landscape: understanding the shifts in certain tax deductions. Our discussion today is informed by a detailed look at recent tax guidance, specifically Publication 17, focusing on what's happened to casualty, theft, and miscellaneous deductions for the 2024 tax year. Let's be honest, tax rules can feel like a moving target, and recent tax law changes have significantly impacted what many of us might have previously claimed on our returns. A couple of things really stand out from this guidance. First, the big headline is that most miscellaneous itemized deductions 2024, things many people used to claim, are simply no longer deductible for the vast majority of taxpayers. Second, while that door has closed, the rules around Casualty Loss Deduction 2024 and Theft Loss Deduction 2024 are now much more specific, mainly focusing on income-producing property. And third, there's important federally declared disaster tax relief available, which provides critical exceptions and support. Understanding these changes is absolutely key to seizing financial control, one of our core beliefs here at Safe, Simple, Sound. Knowing what you can and cannot deduct helps you understand financial choices and plan accurately, avoiding surprises come tax time. It's all about making informed decisions. Get ready for a practical discussion to help you navigate these important Schedule A deductions for the 2024 tax year. Let's get started. First, we're tackling something that might feel like a bit of a magic trick gone wrong for some taxpayers: the Great Vanishing Act. Understanding eliminated miscellaneous deductions for the 2024 tax year. All right, let's set the stage. When you file your taxes, you generally have two main paths to reduce your taxable income. Take the standard deduction, a set amount based on your filing status, or itemized deductions using Schedule A. Itemizing means listing out specific expenses like medical costs, state and local taxes, mortgage interest, and charitable donations. You typically choose whichever path gives you the bigger deduction. Now here's the twist. Recent tax law changes have significantly shaken up this calculation, especially concerning what used to be called miscellaneous itemized deductions. These changes really impact that standard deduction versus itemized 2024 decision for a lot of folks. So, point number 2, and this is the big one. The 2% AGI rule is history, but maybe not in the way you'd hope. Remember how certain deductions, those miscellaneous ones, were only allowed if they collectively exceeded 2% of your adjusted gross income, or AGI. Think of it like a hurdle you had to clear before those expenses even started counting. Well, for the most part, that hurdle is gone, because the deductions themselves have largely vanished for the 2024 tax year. Due to major tax law changes, most expenses previously subject to that 2% floor are simply no longer deductible on Schedule A. So, what exactly disappeared in this Vanishing Act? Let's talk specifics. Point number 3, key eliminated deductions. These are the ones that used to be pretty common. First up, un-reimbursed employee expenses. This was a big one. Think about things like uniforms you had to buy, tools your job required but didn't pay for, maybe even certain home office expenses if you were an employee before the rules changed. Now, for most W-2 employees, these costs are no longer deductible federally. There are potential exceptions for certain very specific qualified roles, like some military reservists or fee-basis government officials, but for the average employee, that unreimbursed employee expenses deduction is gone. Next, tax preparation fees. Yep, the cost you pay for tax software, online filing services, or even hiring a tax professional, generally not deductible anymore as a miscellaneous itemized deduction. So, that fee you pay your accountant or that TurboTax subscription, you can't write it off like many used to. Is tax preparation fees deductible? For most, the answer for 2024 is no. And third, most investment-related expenses. This includes things like investment advisor fees, fees paid to collect interest or dividends, the cost of a safe deposit box used purely to store investment documents, even clerical help related to your investments. These are generally off the table now for individual investors claiming Schedule A deductions. Think back for a moment. How did the elimination of these common deductions, like unreimbursed employee expenses and tax prep fees, change your approach to itemizing versus taking the standard deduction? For many people, losing these meant their total itemized deductions suddenly fell below the standard deduction amount, making the standard deduction the clear winner. Moving to point 4, beyond those big three, there are other notable eliminations. These might be less common, but still impactful if they applied to you. Hobby expenses. You generally can't deduct expenses related to a hobby activities not engaged in for profit beyond the income that hobby generates. Casualty and theft losses of property used as an employee. If your work tools were stolen, for instance, that loss is generally no longer deductible here. We'll talk more about other types of casualty theft losses in our next segment. Separately billed IRA trustee fees. If you paid administrative fees for your IRA directly, instead of having them taken from the account itself, those used to be potentially deductible. Not anymore. Reflecting on past tax years, which of these now eliminated miscellaneous deductions provided you the most benefit, and how significant was that impact? Maybe it was those union dues, the mileage for a second job, or those investment fees. It's useful to recognize what's changed. Also, beyond the major examples, what other niche expenses might taxpayers mistakenly assume are still deductible under the old rules? It pays to be current. Now, there's one tiny niche exception worth mentioning briefly. Point 5, the claim of right exception. This is pretty specific. If you had to repay more than $3,000 of income in a later year that you had already paid tax on in an earlier year because you thought you had a right to it then, but later found out you didn't, there might still be a way to get tax relief for that repayment. It's generally not handled as a miscellaneous itemized deduction anymore, but the IRS Guidance Check Publication 17, or 525, outlines how you might take it as a deduction elsewhere or claim a credit. Again, this is a very specific situation, but good to know it exists. Okay, let's recap the Great Vanishing Act. The key takeaway for the 2024 tax year is that due to tax law changes, most miscellaneous itemized deductions that used to be subject to the 2% AGI floor are gone. This includes common things like unreimbursed employee expenses, tax prep fees, and investment expenses. This shift makes the standard deduction a much more attractive option for many taxpayers compared to itemizing on Schedule A. So here's your action item for this segment. Review your expense records and perhaps even glance at your tax return from a few years ago. Identify any miscellaneous deductions you previously claimed that are no longer allowed for the 2024 tax year. Understanding what's off the table is just as important as knowing what's still on it. Now, hearing about all these eliminated deductions might sound a bit gloomy, but don't worry, itemizing isn't completely obsolete. There are still significant deductions available, including some related to losses, but the rules are specific. That's exactly what we'll dive into next. Casualty and theft losses. What can still be deducted? We'll explore the exceptions and specific situations where you might still be able to claim these types of losses. So the first key thing to understand is the shifting focus. Remember how we just discussed that unreimbursed employee expenses are largely gone? Well, that includes casualty or theft losses related to property you used as an employee. So if your work laptop got damaged and your employer didn't cover it, that specific type of loss is generally no longer deductible on your personal return for the 2024 tax year. That door has mostly closed. However, the tax code does still allow deductions for casualty and theft losses on a specific category, income-producing property. This is the main exception you need to know about. What does that mean? We're talking about assets you hold for investment or use in a business you own, not for personal enjoyment. Think about things like stocks or bonds that were physically stolen, perhaps old paper certificates. A rental property you own that gets damaged by a storm. Valuable art or land you purchased purely as an investment, hoping it would appreciate if it's damaged or stolen. This is different from your personal residence, your family car, or the TV in your living room. Those are personal use items, and losses on those are generally not deductible unless it's part of a federally declared disaster, which we'll cover next time. But for this specific income-producing property loss, you typically report it using Form 4684, specifically Section B, and the result potentially flows through to Schedule A, line 16, as an itemized deduction. Now, just having income-producing property damaged isn't enough. The loss must result from a casualty or theft. The IRS defines a casualty as damage, destruction, or loss resulting from an identifiable event that is sudden, unexpected, or unusual. Think fires, floods, major storms, vandalism, or even accidents if they fit that description. Theft is simpler, the unlawful taking of your property. What doesn't usually qualify? Gradual deterioration isn't sudden. Think termite damage discovered over time, or slow water leaks. Simply misplacing something usually doesn't count either. It needs to be a specific, identifiable event. So, a pipe bursting and flooding the basement where you store investment inventory likely qualifies. Finding out your investment property's foundation slowly cracked over 5 years? Probably not a casualty loss deduction. It really hinges on that sudden, unexpected, or unusual event criteria. Okay, let's say you do have a qualifying loss on income-producing property. How much can you deduct? Conceptually, the deductible amount is generally the lesser of two things: the property's adjusted basis, usually what you paid for it, plus improvements, minus depreciation if applicable, or the decrease in its fair market value because of the casualty or theft. And critically, you have to subtract any insurance reimbursement you received or expect to receive. If insurance covers the entire loss, you don't have a deductible loss for tax purposes. Now, I'm keeping this high level because the actual calculations can get more complex. There are often additional limits, like reducing each loss event by $100 and then potentially limiting the total by 10% of your adjusted gross income, AGI, depending on the specifics. The details are really spelled out in IRS Publication 547, which is the go-to guide for this. This brings me to maybe the most important practical point. Record keeping is absolutely crucial. If you ever hope to claim a casualty loss deduction 2024 or a theft loss deduction 2024, you need proof. Think about it. If you went to return something expensive to a store, you'd need the receipt, right? The IRS is similar, but for potentially much larger amounts. You'll need evidence of ownership. How do you prove you owned the property? Deeds, brokerage statements, purchase receipts. Value. What was its basis? What was its fair market value before and after the event? Appraisals, receipts. The event. Proof the casualty or theft actually happened. Police reports for theft, photos of damage, repair estimates, insurance reports. Insurance, documentation of any insurance claims filed and the amount of reimbursement received or denied. Think about your valuable income-producing assets right now. Do you have good records? Could you prove their value and your ownership if something unexpected happened tomorrow? Being proactive here can save enormous headaches later. Maybe take photos, scan receipts, and keep digital copies securely stored. Okay, let's quickly recap the key takeaways for casualty and theft losses in 2024. 1. Losses on property used as an employee are generally gone. 2. The main potential deduction is for income-producing property investments, rentals, etc. 3. The loss must stem from a sudden, unexpected, or unusual event, casualty or theft. 4. The deductible amount is based on basis value decrease minus insurance and subject to further limits. 5. Documentation is non-negotiable. If you think you might have experienced a qualifying casualty or theft loss on income-producing property during the 2024 tax year, your next step should be to dive deeper. Consult IRS Publication 547, that's Pub 547, titled Casualties, Disasters, and Thefts, and carefully review the instructions for Form 4684. Those official resources provide the detailed rules and calculations you'll need. And as always, consider talking with a qualified tax professional, especially if the loss is significant. Now, I mentioned earlier that losses on personal use property generally aren't deductible, with one major exception: federally declared disasters. That's a whole different set of rules with potentially significant tax relief implications. So in our next segment, we'll unpack exactly what that means and how those special rules work for 2024. All right, folks, welcome back to Safe, Simple, Sound. In our last segment, we dove into the often confusing world of casualty and theft loss deductions, especially how the rules have tightened up significantly for personal property unless it's income producing. It can feel a bit restrictive, right? But there's a really important and, frankly, quite humane exception to those general rules that we absolutely need to talk about today, especially as we head into seasons where severe weather events can unfortunately become more common. We're focusing on federally declared disasters and the special tax relief rules for 2024 that can apply if you're impacted. When a major event like a hurricane, wildfire, flood, or tornado is severe enough to be officially declared a federal disaster by the president, a different set of tax rules can kick in to help people recover financially. It's a crucial area to understand because it can make a significant difference during an incredibly difficult time. So, let's break down what this means for you. First, and this is the big one, remember how we said losses on your personal home, car, or belongings generally aren't deductible anymore? Well, if that loss occurs as a direct result of an event within a federally declared disaster area, the game changes. Suddenly, losses to your personal use property can qualify for a casualty loss deduction. Think about the financial impact of losing personal items in a widespread flood versus, say, a localized house fire not part of a larger declared disaster. The potential tax benefit in the disaster scenario can be substantial, offering a lifeline when you're facing immense unexpected costs. It's a critical exception designed specifically to aid recovery. Now, how do you actually claim these specific disaster losses? The process involves Form 4684, casualties and thefts, just like other casualty losses. However, these personal losses from federally declared disasters typically flow to a different line on Schedule A, usually line 15, separating them from any investment property losses you might report on line 16. What's also really helpful is that the IRS often allows you to choose. You can claim the casualty loss deduction on your tax return for the year the disaster struck, or you might be able to amend your prior year's tax return and claim it there. Why would you do that? Well, claiming it on the prior year's return could potentially get you a refund much faster, providing needed cash flow sooner. So, let me ask you this. Just reflecting for a moment, how does knowing this potential difference, the ability to deduct personal losses and maybe even claim them earlier, change how you might think about financial preparedness or recovery if you live in an area prone to natural disasters? It really highlights the importance of understanding these specific provisions. Okay, navigating this, especially after a traumatic event, can feel complex. So, key point is knowing your resources. The absolute go-to guide from the IRS is Publication 547, titled Casualties, Disasters, and Thefts. It dives deep into the rules. And crucially, how do you know if your event qualifies? You need to check the official FEMA website. That's FEMA.gov. They maintain the official list of federally declared disasters. Bookmark that one if you live in an area that might be affected. Now, tax relief isn't just about deductions. Money you receive to help you recover might be non-taxable. The IRS specifically notes that certain qualified disaster relief payments can be excluded from your gross income. Think of grants to help with essential repairs or temporary housing. The reference article specifically mentioned examples like certain payments related to the East Palestine, Ohio train derailment and qualified wildfire relief payments. This means you get the help without increasing your tax burden, which is exactly how relief should work. Always check IRS Publication 547 or specific IRS announcements for the details on what qualifies. And finally, facing a major disaster often means needing access to funds quickly. For federally declared disasters, special rules often allow affected individuals to take distributions from their retirement plans, like a 401k or IRA, without paying the usual 10% early withdrawal penalty if they're under age 59.5. This provides vital financial flexibility. Now, it's critical to remember, while the penalty might be waived, the amount you withdraw is generally still considered taxable income. But avoiding that extra 10% hit can make a huge difference when cash is tight. Just thinking about that, beyond the direct property loss or getting relief payments, what other financial hurdles might someone face after a major disaster? Things like navigating insurance claims, documenting everything meticulously for tax purposes, maybe even dealing with temporary job loss. It really underscores why these tax relief measures are so important. What steps could someone take immediately after an event, assuming it's safe, of course? To start documenting potential losses, taking photos, gathering receipts or appraisals if possible, keeping records of any relief received. Being proactive can make the tax side much smoother later on. So, to quickly wrap up the key takeaways on federally declared disaster tax relief for 2024. 1. The big exception, personal property losses can be deductible. 2. Claim these using Form 4684, usually hitting Schedule A, line 15, with a potential option to claim in the prior tax year. 3. Your key resources are IRS Publication 547 and, crucially, FEMA.gov for official declarations. 4. Some disaster relief payments you receive might be tax-free. 5. You might be able to access retirement plan funds early without the 10% penalty, though the distribution is still typically taxed. Which brings us to our call to action for this segment. If you were impacted by a significant natural event, hurricane, wildfire, flood, or anything major, please take a moment to check the official FEMA website, fema.gov. See if your area and the time frame of the event fall under an official federally declared disaster. Knowing this status is the absolute first step to potentially unlocking these valuable tax relief options we've discussed. It could make a real difference in your financial recovery. Dealing with the aftermath of a disaster is incredibly challenging on so many levels. Hopefully, understanding these potential financial aids provides a little bit of clarity and support. That brings us to the end of today's deep dive into the current rules surrounding certain tax deductions for the 2024 tax year. We covered quite a bit of ground, untangling some key tax law changes. We started with the Great Vanishing Act, confirming that most miscellaneous itemized deductions 2024, like those old unreimbursed employee expenses or tax preparation fees, are unfortunately off the table for the vast majority of taxpayers when considering itemized deductions 2024. Then, we clarified the much narrower path for claiming a Casualty Loss Deduction 2024 or Theft Loss Deduction 2024, focusing now primarily on investment property loss deduction scenarios reported via Form 4684. And importantly, we highlighted the specific rules and potential relief available under federally declared disaster tax relief, a critical exception for those impacted. I think the biggest takeaway here is understanding what's gone and what specific situations might still allow for certain loss deductions on your Schedule A deductions. Knowing this helps you accurately plan and ultimately seize financial control by avoiding surprises and making informed financial choices, which is exactly what we aim for here at Safe Simple Sound. It really underscores why comparing your potential itemized total against the standard deduction is more crucial than ever. Thank you so much for tuning in and navigating these tax details with me today. I truly appreciate you being part of the Safe Simple Sound community. Definitely check out the show notes for this episode. We'll have links to resources like IRS Publication 547 and the FEMA website, which are essential if you think the disaster rules or the remaining casualty loss rules apply to you. And if you found this discussion helpful, please consider leaving us a review, sharing the episode with a friend who might be wondering about these deductions, and hitting that subscribe button so you don't miss our future conversations. We'll be back soon with another topic designed to help you build that financial confidence. Remember, understanding the landscape is the first step to making those safe, simple, and sound financial decisions. This is Alex signing off. Stay informed, stay empowered, and talk to you next time.